Alistair, do you see a rocky road ahead for equities, especially when physical gold and silver metals are soaring toward another 20 to 30% gain by the end of 2025?
The answer to that is yes. I have no doubt that in the coming weeks, you will find, particularly if gold goes higher in currencies, which, as we should note, is actually currencies going down, that the mainstream media will start talking about gold is rising because it is reflecting risks. They may not understand what these risks are. We can understand what those risks are. But that, I think, is something which people will begin to latch onto. Now, I would expect big portfolio shifts coming out of particularly holdings of foreign equities and going into gold. The problem that you have is that you might realize, say, dollars if you were a foreign institution holding dollar equities, of which the figure at the moment is roughly $15.5 trillion of equities are held by foreigners. I'm talking about in the US equity market, where they start liquidating their positions because there is a bubble, which I'll come on to in a second, then that's going to drive up the dollar down because there's no point in them selling equities and to hold on to dollars. But the question then is, what do they buy with all the other G7 nations in exactly the same position? That's why they will go into gold. I think that's the important point to understand. As to the danger in equities, why that flow is likely to happen, we can see this situation being very, very similar to the Wall Street crash in 1929 running through to 1932. This, just the same as in 1929, this period has seen a rapid expansion of credit pushing up equity values. If you look at the numbers from FINRA, they say that margin finance, and this isn't to do with futures and options and forwards and so on, derivatives. This is just people borrowing money in order to invest in equities. In other words, leveraging up their direct portfolios. That level of credit in America has risen to over $1 trillion now. And bear in mind that back in 2010, it was only about 200 billion. This is really what's been funding this situation. This is similar to the roaring 20s, when everything was so good because there was so much credit being pushed into the market and everybody felt happy and wonderful and all the rest of it. And even shoeshine boys were telling you, the last guy whose shoes he shined came up with this tip and, he should know a thing or two. That is basically where we are today. The other thing is that we had the Smoot-Hawley Tariff Act of 1930, which was discussed in Congress in 1929, enacted in, I think, about April the following year by President Hoover. So the combination of two things, the credit bubble bursting and destructive tariffs under the Smoot-Hawley Tariff Act, is exactly what we have today. And anyone who doesn't recognize this really has got absolutely no concept of the environment in which we live. So I would say that the prospects for the US stock market, and therefore all our stock markets, are extremely bleak. But where do you go with it if you try and sell out? I mean, apart from anything else, if this is going to be a market which probably falls, once it starts falling, falls very, very rapidly. So, you're going to have to get out extremely quickly, which is very difficult to do psychologically. But when you do that, what the hell do you do with the proceeds?
Yeah.
Where are you going to go with it? And that, I think, is why we will see the big portfolio shift, if you like, out of inflated assets into real money. And of course, that will effectively undermine the purchasing power of credit in the form of currencies as well. Interesting times ahead, I think.
Great answer to that question, Alistair. Well, I know what I'm doing.
Oh, I've already pulled mine out.
I'm already there. Right.
And by the way, when I say I pulled my money out, I had shares in a couple of gold mining companies in Australia, and one was performing okay, but the one wasn't. So I got rid of the first one, what wasn't, and I've only just finished pulled out from the other one. Now, people are saying, well, some good gold mining companies will go up 3 times, 10 times, 12 times, but I look at the fact that there is no risk at all when you have physical metal. No risk at all. And Darren and I have a great comment that all you need is a feather duster to get off the dust. That's your maintenance program, right? But when you're talking about equities, you're talking about somebody else messing around with your money, right? It's not, it's not their money, it's your money.
That's it.
And so I just, I've pulled out completely. Yeah.
Yep. I like being my own central bank.
Absolutely.
I'm in control.
Yeah.
Absolutely. Actually, I can add a thing to that, and that is, people actually look. A lot of people who understand what we're talking about think that get into mines, that's really going to run. And of course, if you've got enough time, it will run. If this crisis, let's say, takes another 2 or 3 years to unfold, yeah, fine. But the problem is that when you get an equity market crash, what happens is you have to sell everything. And so on that basis, and of course the psychology of the situation is that when things are really falling down around your ears and you've got profits here, you try and realize those profits, and it all gets killed. So, I'm afraid that there is quite significant risk in owning mines, which people don't really realize. It's got nothing to do with the underlying operation of the mines or their future profitability, but it's just that the shares are held by people who are going to be in distress, which basically means that those shares will be sold.
Yeah.
A wise man perhaps steps back, lets it all wash out, and think, I'm going to buy some of these. Because the great thing about a mine is that, it's producing gold, silver, whatever, demand for that output is going to continue, not in the G7 countries, but in Russia, China, India. Mm-hmm. I mean, at the moment, we've got Shanghai Cooperation and BRICS meetings going on in China. And I mean, the funny thing about this is that Trump pisses off Modi and just drives Modi, if you like, into a closer association with China, with which he's got border disputes, and Russia. Well, they've always been close to Russia anyway. So, you've now got, in terms of large nations there, you've now got China, India. Russia is large in territorially rather than population. Iran, and also Turkey, which is sort of sitting on the fence, as it were. But I have no doubt which way Turkey is going to jump. And then you've got, some nations which we don't even think about. I mean, how about Indonesia, for example? The population of Indonesia is extremely high. I mean, I think something like 250 million people or something. I mean, suddenly we got good 70% of the world is going to rapidly industrialize, and they're going to need the metallic output of Australian mines. So, when the distress selling from people who've got NVIDIA and all the rest of it is over, that's going to be the time to look at them, because I think that then actually could be a very, very good hedge against collapsing currencies.
Yeah.
But we're certainly not there yet. So I think, Brian, you're absolutely right. You get out of that stuff. There will be a time, I think, to go back into it. And that's an interesting point, I think, to debate in the future.